Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us remotely from Chicago, we have Mark Sebastian. He's the founder of Option Pit. We're going to discuss the largest shift in trading ever. It's this one indicator that's changing everything. Mark, great to have you with me as always. And past 4 or 5 weeks, traders wanted that volatility. It's certainly back in the market.
It's absolutely insane. And, you got to ask yourself, is volatility here to stay? I mean, and I don't mean like forever, but I think a lot of traders have gotten used to volatility being, 10, 11, 14. They think of a 20 VIX as high. And I think people need to shift their focus and shift their ideas and start to realize that, we could be in a volatility environment where the VIX, the SIBO Volatility Index, and the VXN, which is the SIBO Nasdaq 100 Volatility Index, are both well above 20 for an extended period of time, and maybe above 40 for months and months and months.
All right, let's go through the presentation here. Our first slide, of course, the option pit disclosure. Everyone can take a quick look at that. And we move to slide 2. And again, this is what we're talking about, permanent volatility. But I also want to take a look at some charts. So as we move along to slide 3, here we are taking a look at the SPX. And, we see in the beginning month and a half of the year, just slow and steady. And all of a sudden, that big volatility just came back into the market.
Yeah, it was, it was interesting. A lot of people point to that Monday, February 24th is the beginning. But if you were paying close attention, on Thursday, February 20th, there was a really weird kind of intraday sell-off where we went from, basically unchanged to down 40 to then back to kind of down 10. And there was no reason, no news, nothing. And that was our first kind of major player, I think, getting out of the market, and it sent, I think, warning signals across a lot of professionals. And you start seeing the S&P. That's basically the top of the S&P, and it's been down, almost straight down ever since.
Yeah, and I want to go along to our next slide here because you make a great point. You raced nearly 4 years of returns in the span of 4 to 5 weeks. The velocity of this move is quite incredible, and I think it caught a lot of people off guard. Yes, traders wanted volatility back in the market, but this was, you're known as a vol trader, been doing this for 20 years. Have you ever seen this type of move before, and the sustained move?
No one has. No one has. This outpaces even, during even the crash of 1929, they had individual days that had lots more individual volatility. But we've never had so many 4, 5, 6, 7, 8, 9, 10% moves in a 30-day period in history. So this move is nothing like we saw in 2008. It's really not even something like we saw in 87 or in 2000. This is a totally unique and different move in the S&P 500 and in markets as a whole. They've never behaved this way. Like I said, even the crash of 1929, by some measures, is less volatile than what we're seeing right here. And that is really astounding when you think about it, that this is historic movement. I mean, we may never see this type of movement again.
All right, well, I got to capitalize on it now. If you're a vol trader, that's for sure. Speaking of, let's move along to our next chart here, the VIX.
Mm-hmm.
Yeah, and basically the inverse of what you're seeing on the S&P 500. We certainly have not seen that kind of activity in the past 2 years for sure.
No, we had an all-time high in the VIX last week. But I do want to point out something very important on this chart. And that is that obviously we're talking today and the markets are way up. But as of that absolute peak in the VIX, the S&P 500 as of yesterday morning was off about 250, 300 points, and the VIX was down 20 points. Mm-hmm. So what we're seeing is the VIX and the S&P correlate, which means that the VIX is down and the S&P is down. And to me, And to a lot of professionals, that is a sign that the risks of the market continuing this absolute collapse that we've seen are starting to unwind, starting to come off. The easy, sneeze, sell the market, come back and buy it later in the day, and you make money trade is off the table. The risks of being short have equalized, or maybe now exceed, based on what we're seeing today, that of being long the market. So the volatility index is behaving as such that we may be at we may have seen at least a temporary bottom. And what I would point out, if you look at the next slide, is that peak volatility, which we had last week, tends to come before we hit peak, the bottoms in the market. But it is usually a sign that you can start accumulating. And I have started to find ways to try and get into this market.
Yeah. And Mark, even on that slide that we're looking at, VIX, with the bullet points over here, and you did mention that when it falls with the market, it can be a sign of the bottom. But when we're still having these days where we're up 4%, down 5%, even the intraday swings are, if you look at a one-day chart, even like yesterday, for example, was a perfect day. And of course, yesterday, Monday, March 23rd, for those of you catching this on the replay, the intraday chart, it almost looked like a one-year chart because there was so much movement in it, which is very unusual.
Yes.
Do you think we need to stop seeing these extreme reversals before you start thinking more longer term?
Well, yeah. I mean, I'm not saying, what I would say from a longer term perspective is that with volatility at historic highs, there are trades that, a Warren Buffett would do that make a lot of sense to me. Stuff that you really, really like, that, if you were smart, you got your cash out, you've been sitting on the sidelines, or you've got extra cash to put in play and you're wondering when. There are some deals out there that we may not see again for a very long time. One name in particular that I've been paying pretty close attention to is Coca-Cola Company, which is, trading below $40 as you and I are talking. And it was over 60 before this thing began. And go to the supermarket or Target or Walmart and go look at the pop aisle or the soda aisle if you're, on the East Coast, or the Coke aisle if you're in the South, and you tell me how much soda products there are, and the answer is there's none. The Coca-Cola now has like a 4.5% dividend, and is now trading below where it was 5 years ago. The last time it traded this low was in the during the middle of the 2015 crash, which was kind of the last time we saw markets anything like what we're looking at now, which was the last time China really turned into a mess. So that's one that is not on our charts, but is a name that I think I look at and I say, why wouldn't I want to start accumulating some of this? So if there are some really good names that make sense to you, this is a level with the VIX behaving where it is, where I'm starting to dip my toe. Do I go whole hog? Am I giving the all free and clear? No. But do I think that we're on the back end of the absolute craziness? Yes.
Yeah. All right. Let's go along to our next slide here, the VVIX. Tell us what that's about. Why is that an indicator for your work?
So VVIX is kind of like my early indicator. I'm watching how VIX moves with the S&P, and then I'm really watching kind of the severity of VVIX moves. When VVIX gets over 200, that is a sign that the market is really stressed. And when the VVIX starts selling off on rallies and rallying on sell-offs, because people are playing volatility mean reversion in terms of volatility needs to come off, you are, you're now, that's a place where VVIX is a pretty good indicator, and will tell us, hey, it's the first green shoot. And VVIX is basically come off to levels where between it and the VIX, and until today, some slowing volatility in the S&P.
Yeah, Mark, actually, 1 second. I just want to pull up that chart, our final chart here with the VVIX, and we can see that spike earlier in March, and it has consistently been coming down if we take a look at the chart.
Yeah. So all of the kind of the major volatility measures that I pay attention to, minus kind of one or two that are in what I use to develop my hedging programs and my programs to go in and buy the market, have kind of turned off, which is why I'm starting to step in and put a little bit of money into the market. I'm not getting the green light from my systems, but I'm no longer getting a sell or stay out of the way of this market. You might say I'm at the yellow light, the don't buy, don't sell, but if you have to do something, buy is where I'm at. So what I would, if I was in a life or death bet on the market, where it's going to be in 2 weeks, and if I'm wrong, well, if I was in a life or death bet and I had to be right in 2 weeks, I would bet up, not down. Let's put it that way.
All right, Mark. Great stuff as always. Thanks so much for joining us from Chicago.
All right. Thanks, Jill.
All right. And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.